Good afternoon, good morning, good evening, depending on where you're joining us from. My name is Chennai Mukumba, and I am the Policy Research and Advocacy Manager at an institution called the Tax Justice Network Africa. TJNA is a civil society organization that's concerned with the amount of resources that leave the African continent and the impact that that has on the attainment of our developmental objectives. And so we are really excited to be a part of this meeting. This meeting that we are bringing to you is part of the APRI Events Afternoon. We hope that you enjoyed the earlier session that took place on the G7 and Africa towards a strong partnership for progress on climate protection. And in case you missed it, you will be able to find the recording of that on your YouTube page. This particular webinar this afternoon is on Africa's debt architecture, the global financial crisis, rating agencies, and restructuring, and is also being organized by the Africa Policy Research Institute. Before we begin, just a couple of logistical announcements. This webinar is being recorded and will be available on the APRI website within a few days. Following the presentations that are really going to serve as the foundation for the conversation today, we're going to have a panel discussion, after which we're going to open it up for a Q&A session. So we'd like to kindly request that as the discussions are taking place, please prepare your questions and go ahead and post them in the chat box. If possible, it would be great if you could indicate to whom your questions are being addressed. And then following the panel, I'll do my best to get your questions to the panelists themselves during the Q&A. So let's get straight into it, shall we? Today, we are here to have a frank and open conversation with thought leaders, researchers around a really important topic. The objective of our conversation today is to stimulate a reflection and hear from various stakeholders their different views around this current discussion on debt. So we're going to try and take an African lens and reflect on the current state of Africa's debt architecture, the global financial crisis, rating agencies, and restructuring. And we hope that this discussion is going to meaningfully contribute to the discussions that we know are taking place on this topic in a number of various policy circles. So by means of very brief background, as we jump into this topic, after the cancellation of debt that developing countries underwent in the early 2000s, we saw a proliferation of new creditors emerge as African countries began to re-enter the capital market. So Eurobonds have grown to become an important source of financing for development in various countries across the continent. Policymakers have argued that the growing activity in issuing Eurobonds is as a result of more easily available credit information. In response to the increased activity in the Eurobond market, the frequency of assigning sovereign credit ratings in Africa has risen dramatically since the 2008 financial crisis. Compared to the first sovereign credit ratings, most African credit ratings have deteriorated. And this has resulted in serious negative implications on the cost of servicing debt. The share of traditional and relatively new creditors in African external debt varies a lot across African countries. In 2019, 8 African countries accounted for over 80% of private creditors' debt, whereas 3 countries accounted for 50% of China's debt. The majority of infrastructure investments are being delivered through the use of PPPs, and these have been shown to pose serious economic and social risks. The absence of a successful sovereign debt resolution system that involves all creditors means that the resolutions are falling short of supporting recovery for African countries, particularly in light of the evolution of current debt profiles. So to help us unpack this, as I mentioned earlier, we are going to have 2 presentations that are going to be given to us by 2 speakers, namely Aurore Sokpoh as well as Nora Chirikure. And they will present summaries of 2 policy briefs that have recently been published by APRI. Before we get into that, we are going to have a couple of welcoming words that are going to be given to us by the founder and director of APRI, Mr. Olumide Abimbola. Olumide's areas of focus include economic informality, trade policy, regional integration, and natural resource management. And he has conducted research and worked in Tunisia, Cote d'Ivoire, Benin, Togo, and Nigeria. He's also worked with high-level government officials in several other African countries. Mr. Olumide, I'm now going to give you the stage to go ahead and welcome everybody who's with us today. Over to you.
Thank you very much, Chennai, for the introduction. And thank you to everyone for being here to join us in reflecting on the current state of Africa's debt architecture and thinking about the continent's global financial access. First of all, for those who don't know APRI, we are an independent and non-partisan think tank based in Berlin, Germany. We conduct policy actionable research that we hope can contribute to the Africa-focused policymaking processes in Germany and Europe. Of course, as a think tank, we engage with policymakers. That's part of why we exist. But we also try very hard to engage with the general public because one of our goals is to try and improve the quality of the debate on Africa in the German public space and in the media as well. So on the areas of work that we have three. The first one is climate change. Under that program, we look at policy options that can allow African countries to address the existential crisis that the climate crisis is for them in a way that promotes economic development and that also creates jobs, because we think that there is no conversation to be had if these two factors are not part of the consideration. Our second area of work is digital policy. Under the digital policy area of work, we generate evidence-based research that can help position African countries to accelerate their digital transformation. And we also, at the same time, look to understand Africa's digital agenda. We actually did a big report on that last year in order to provide recommendations for how partners can effectively support it being Africa's digital agenda. So our third area of work, where our conversation today is situated, we call it economy and society. Under the program, we look at topics such as trade policy and private sector development. We also look at Africa's relationship with other countries and regions of the world. So with Europe, with Germany, with China, with Russia, etc. In addition to that, we look at the ability of African states to fulfill the roles that we've now come to expect of modern states, such as infrastructure development. And one of the major ways of fulfilling this is the ability to, of course, raise financing and investment, which is needed to develop infrastructure that the states need. This is where the question of credit, the question of debt, the question of ratings come in. Last year, as the first foray into this space, we started looking seriously at debt and credit ratings, and we have so far published 2 policy briefs on the general topic of debt and credit ratings, looking at the debt and ratings trends in African countries. Debt and the cost at which African countries can borrow, they are key to economic prosperity. For example, when we think about it, when countries begin to prioritize maintaining credit ratings through tightening macroeconomic policies, which, by the way, tend to be counterproductive for long-term investment and growth, there can be negative effects on debt crisis prevention and resolution as well. So in the current context, when countries are recovering from the social and economic impacts of COVID, when they're dealing with the ongoing impacts of the climate crisis, and on top of that, with the impacts of the war in Ukraine, it is important that African countries are not just able to build resilience. I mean, that's important, but not just that. But they're also able to transform their economies and create the jobs that we know are needed for some of the youngest populations in the world. For us at APRI, a starting point was to understand how African governments are financing activities that can contribute to transforming their economies. More specifically, we looked into the key developments in the debt landscape and some key factors affecting the cost at which African countries can borrow. I'm very happy to say that we will be presenting insights from our work on this today. But beyond presenting the trends, right, I'm also very happy that we have an esteemed panel with us today, not just to sort of unpack the issue, but also to cast the view forward and think of solutions to how we do not end up in this space again a few years from now. On that note, I hand it back to you, Chenai, to introduce our speakers and panel. Thank you very much.
Thank you very much, Olu. So on that note, like you've indicated, we're now going to dive into our first presentation for today on Africa's debt landscape, the scope for sustainability. Our first speaker is Aurore Sokpoh. Aurore is an economist consultant who is researching on Africa's sovereign debt. She has partnered last year with AFRODAD to carry out her dissertation research as part of her second master's in Africa and international development at the University of Edinburgh. And before that, she worked as an economist at France Invest, the French Private Equity Association. Aurore, over to you.
Thank you very much, Chennai. Good afternoon to everybody, or good evening, depending on where you are. I want to start by thanking AFRI for the invitation. It's a very great pleasure for me to be here and today to present and discuss this policy brief that we have written together. So let's start first by talking a little bit about the rationale behind the policy brief. So as Chennai and Olumide have already mentioned, this paper, which was written in the end of 2021, aims at providing a screenshot of the debt situation in African countries, as well as the drivers and challenges of debt accumulation after observing a new rise in level of public debts across many African countries. Next slide, please. So the presentation will be structured as such. First, I will present where we stand today, what the current debt landscape looks like globally in Africa, then provide some explanation of how we get to this situation, and finally present the existing debt restructuring mechanism and solution that might help tackle the challenges of this new debt accumulation. So where do we stand? The paper starts with noticing that since the HIPC and MDRI initiatives that canceled most of the debt in 2006, African debt levels have increased by nearly 140% to get to 841 billion over a 10-year period from 2009 to 2019. This rise is verified for each category of debt distress country. Next slide, please. As you can see on the figure here, who shows the Africa's debt accumulation since 2010. So.
Aurore, I can't hear you. I don't know if that's just on my side.
Can you still hear me?
I can hear you now. Go ahead.
Thank you. Thank you. So along with the size of African external debt, the shares of private creditors and emerging economies have also grown, although the profile may vary between countries. So according to the World Bank database, in 2019, 8 African countries accounted for over 80% of private creditors' debt. And between them, we can find countries such as South Africa, Egypt, Nigeria, Morocco, and Angola. Whereas 3 countries accounted for 50% of China's debt, such as Angola, Ethiopia, and Kenya. In this figure, you can see that the traditional agents have seen the space shrink to the benefit of commercial lenders in China. So from early 2020s to 2019, the private creditors have grown to 30% to 48%. The predominant shares of private creditors is of great concern, as since 2011, 70% of sub-Saharan African countries' debt servicing has been disbursed to bondholders and commercial lenders, with disbursed amount corresponding to significant portions of the African countries' national revenue. Next slide, please. Therefore, according to data compiled by Jubilee, in 2019, Angola, for instance, has spent around 43% of its total revenue servicing its debt. And fears around debt and sustainability are increasingly palpable, even more so with the economic, fiscal, and social impact of COVID-19. Next slide. The graph, next slide, sorry. Yes, this graph illustrates 7 periods of crisis that have impacted the level of debt globally and especially in Africa. So in the paper, we have highlighted several reasons. Previous slide, please. So as part of the several reasons that we have highlighted in the policy brief, the first is the post-HIPC periods have seen several African countries provided with more liquidity and fiscal spaces, increasing their capacity to gain more debt. Secondly, has been the detrimental effect of structural adjustment program on African economy because of the strong conditionalities that has been tied to this program, and that prompted a strong desire to move away from aid and pursue alternative financing method on capital markets. So although South Africa issued its first Eurobond as far back as 1995, the Seychelles sovereign bond issued in 2006 marked the entry point for many African countries into the international capital markets. So the global financial crisis of 2008 further influenced the attractivity of financial market for African countries. So the unconventional monetary policies undertook by European central banks to maintain their interest rates low has pushed private lenders to look for higher yields on African markets. But what that means for African markets is the increase of the risk premium and the interest rate to be paid. At the same time, the discourse of sustainable development goals also promoted the use of financial instruments for infrastructure that has been identified as precondition for restoring economic growth in developing countries. So bridging the infrastructural deficit has been the core motivation behind African governments' new procurement of debt from international financial institutions. Next slide. So next slide again. Next slide again, sorry. So what are we doing? African countries have entered COVID-19 pandemic period with significant debt that was owed to both traditional creditors like the IMF and new creditors such as China, the Arab Gulf states, and private creditors. So while there were various measures from the international community to support the global economic recovery during the pandemic, the COVID-19 pandemic revealed the ineffectiveness of existing debt relief mechanisms in the absence of a quick and efficient restructuring debt mechanism. So although such efforts are noteworthy, the absence of a successful sovereign debt resolution system that involves all creditors means that other resolution that are current resolution will fall short of supporting recovery for African countries, particularly in the light of the evolution of the debt profiles. So this table shows the existing debt restructuring mechanism. I'll go very quick on a few of them. The DSSI, the Debt Service Suspension Initiatives, have only allowed temporary suspensions of debt service owed to official bilateral creditors and some non-traditional official creditors such as China. But the fears of future credit rating downgrades have discouraged many African countries from applying to those measures. Plus, in 2022, the debt service that has been accumulated throughout the 2-year suspension has resumed in conjunction with any other supplementary loans that were borrowed during that time. I want also to a little bit about the SDR, the special drawing rights. So in August 2021, the International Monetary Fund have announced an allocation of 650 billion special drawing rights, the largest in history, but only 30 billions has been allocated to African countries. And since then, 80 developing countries have been using their SDR, which is a IMF currency, to purchase for other foreign currency or for fiscal expenditure. In recent development, the IMF has launched the Resilience and Sustainability Trust, which would channel SDR reallocation from other countries that might not need them to developing country. But out of the $100 million that has been committed by the G20 or G7 of reallocation, nothing has been channeled yet. Next slide, please.
You have 1 minute.
Yeah, it's fine. So what can be done now is it's time to be very creative of an African-based debt restructuring mechanism that will include all creditors, especially private creditors, because if they are not included, liberated funds will be diverted to reimburse those commercial lenders. And that is something we have seen during this COVID-19 pandemic. And also the debt mechanism that will be guided by the principle of transparency, accountability, and governance, such as the one recommended by the African Borrowing Charter from AFRODAD. And in this, there is an example from the UNCTAD, Sovereign Debt Restructuring Mechanism, who has adopted in 2015 9 basic principles of sovereign debt restructuring processes. Next slide. So there's like the COVID-19, during the COVID-19 crisis, many emerging and developing economies have launched unconventional monetary policies in the market, and a study from the IMF has shown that these policies were successful in significantly reducing the bond yields, so that those kind of solutions can also help African countries during financial market stresses. And there's also the African Financial Stability Mechanism that is actually championed by the African Development Bank, which also can be a solution to be based on for future consideration. Thank you very much.
Thank you so much, Aurore. I know you had a lot of information you needed to squeeze in a short amount of time. You did a great job with that.
Thank you very much, Chinaye.
You're welcome. We're going to move on now to our next speaker for today, Nora Chirikure. Nora is a research assistant at APRI, and she will be presenting on a policy brief entitled, "How are the big three ratings agencies impacting African countries?" So I know this has been quite topical in many debt circles. Nora is currently completing her master's in economics and management science at Humboldt University in Berlin. She holds a BSc from the Erasmus University in Rotterdam, where she majored in politics, philosophy, and economics. In addition, Nora is also a founding member of the Pan-African collective Isufena, where she's responsible for curating events and building partnerships. Nora, over to you.
Thank you for the introduction, Chinaye. I hope you can hear me well.
Yes, we can hear you.
Okay, so we published this policy brief on how are the big three rating agencies impacting African countries earlier this year. We wanted to understand what is the process and the purpose behind getting sovereign credit ratings, and we were also curious to see what are the trends in African countries, and if there is anything interesting to see. So I've structured my presentation as follows. I won't go so much into the Eurobonds to finance development because Aurore has touched on this. I will speak about credit ratings across the African continent, the trends that we see, and the implications of downgrades and what could be done better. So as Aurore has already touched upon, over the past 2 decades, international borrowing for infrastructure finance by African governments has increased, and one increasingly popular way in which African governments have been borrowing is through issuing Eurobonds. And the motivation from both sides, so from the African countries on the one end is the increased access to financial markets through having undergone debt relief initiatives and also wanting to diversify funding sources and rely less on aid. From the lender's perspective, We see that there was a growing optimism surrounding African economies, and especially following the global financial crisis, where interest rates in established markets dropped, investing in African Eurobonds became more appealing, as this would yield higher returns for investors. So the role in credit ratings when countries access global financial markets is that the credit rating, and these are usually from one of the big three credit rating agencies, are meant to measure the ability and willingness of any sovereign to meet its financial obligations fully and on time. They are still the best available source of risk information for emerging economies, and as thus determine the conditions under which governments can access debt markets. Moody's, Fitch, and Standard & Poor's, as I've mentioned, are the three big rating agencies globally. It is worth noting that collectively, these three rating agencies hold more than 95% of the global market share in sovereign credit ratings. And the way in how they assign credit ratings varies. So the credit ratings can be solicited, meaning that governments sign fee-paying information sharing agreements where with the rating agencies, and this was the case for a handful of African countries when they acquired their first credit ratings in the late 1990s. The United Nations Development Program played an important role also in funding African countries' credit rating processes in the early 2000s through its credit rating initiative. So these were the solicited credit ratings that were paid for and where governments gave information that would help the credit rating. There have also been increasing, however, unsolicited credit ratings, and these are credit ratings that are assigned without the issuer requesting them. Thus, there is no formal contractual relationship between the rating country and the rating agencies, and these rating agencies tend to not be paid for and based on publicly available information. So although many countries had received at least one credit rating by 2007, one credit rating from the big three rating agencies, the rating frequency did not rise significantly until after 2010, shortly after the global financial crisis, as we can see in this graph. So we can see that the frequency is quite low before a certain time period, and it increases from a certain time period. And this is still something that we are investigating. So by September 2021, 32 African countries had received sovereign credit ratings from one of the big three agencies. And the frequency across countries varied. So countries such as Tanzania and Togo had only received a total of 2 credit ratings from one of the big three, while countries who have borrowed more from the international financial markets, such as South Africa and Egypt, had received 57 and 64 credit ratings, respectively. Another trend that we see is that for the credit ratings of most African countries, particularly those who have issued Eurobonds, is that the sovereign credit ratings, the current sovereign credit ratings, are worse than their first credit rating. So the credit rating itself and also the outlook, so whether it's positive or negative. And to kind of illustrate this point, I've also borrowed 2 graphs from a paper by Dr. Mishek Mutize and McBride Peter Ndlashamba from 2021, where they show that there is kind of the paradox that whilst there is that high economic growth level in African countries has not necessarily translated to better credit ratings. And one reason they gave in their papers that credit rating agencies dismiss the economic growth as fragile. So here we can see that there is the number of upgrades are not as many as the downgrades, and the purple line shows the economic growth. They also showed another graph which shows that the big three rating agencies tend to generally have a negative sentiment towards African countries as their downgrade activities outweigh their upgrades. So going back to this conversation about the implications of downgrades, I've mentioned before that ratings have an impact on the conditions under which borrowers can access the debt market. So poor credit ratings are said to signal higher risk and tend to thus result in higher cost of borrowing from international capital markets. So when a country is downgraded, there is an increase in its bond interest, and this can often mean that governments are required to pay more on the amount of debt that they owe already. And to date, interest rates for borrowing, interest rates are much higher for African countries than for other regions in the world. So you can imagine the debt accumulation that happens when you are required to pay, when you have higher interest rates, which means you need to pay back more. So it's kind of a cycle that that continues. And for this reason, there also, for many African countries, interest repayments constitute the highest and fastest growing portion of their expenditure. And so some recommendations that we came up with so that the credit rating agencies are being more informative rather than determining the behavior that follows, so prescriptive, we came up with some suggestions. So firstly, some common concerns when it comes to the credit rating agencies is that they might not be using the appropriate methodology and not prioritizing local knowledge. So on the methodology, often they rely on past behavior, but if countries have not been borrowing for a long time, this might not be the best way to measure it, because you then don't have a good, you don't have a long history. And also, in terms of understanding the local context, it's worth noting that there's limited presence on the African continents of the credit rating agencies. S&P and Moody's, for instance, only have one office in South Africa, whilst Fitch has no offices in Africa. Another suggestion is to limit unsolicited credit ratings. So when you give an unsolicited credit rating, it means you probably don't have the full information in order to give an accurate credit rating. And also there's a conflict of interest that arises when the credit rating one gives for is paid or whether it's not paid for. That being said, it is necessary to have stricter regulations of the work of credit rating agencies on the African continent. As an unelected body, credit ratings shouldn't have the power to determine what fiscal and monetary policy African governments implement. So when governments are downgraded or fear being downgraded, their capacity to respect and fulfill human rights obligations can be enormously impacted. And this can be seen that sometimes governments act in a way where they fear downgrades. So this Aurore also pointed towards this with the DSSI initiative that was implemented at the onset of the pandemic. It led to fears of being downgraded. So instead of what may have been better for the health of the population or economic recovery from COVID-19, some governments prioritized debt repayments out of the fear of being downgraded. Finally, another way that the work of credit rating agencies can be improved is to adopt the African peer review mechanism, which involves a multi-stakeholder approach to engage credit ratings on reviewing methodologies, indicators, and the rating processes. This is an initiative by the African Union. So these are some of the highlights from our analysis, and I look forward to the discussion that will follow. Thank you.
Thank you so much, Nora, and spot on with the time. So really good job. Thank you, both of you, for these really, really interesting presentations that have laid the groundwork for today's conversations. So now, to help us unpack what you've just shared, I'm now going to turn to the panelists that we have for today. As I mentioned earlier to the participants on the call, during these interventions, please begin to prepare your questions for this session. And following this, we are going to have a Q&A where you can actively engage with our panelists. And so now I have the pleasure of introducing our thought leaders for today, both of whom have played and continue to play a really instrumental role in shaping the policy debates, as well as providing concrete pathways to our leaders in their respective fields. Our first panelist is Jason Braganza, who is the Executive Director of AFRODAD. Jason is a Kenyan economist with over 10 years experience working on international development in Africa. Jason's work has focused over the past decade on trade and regional integration, finance for development and tax, illicit financial flows, domestic resource mobilization, poverty, and inequality. Jason is now, as I mentioned earlier, the Executive Director of the African Forum and Network on Debt and Development. So, Jason, having listened to the presentations by both Aurore and Nora, they've given us extensive information about Africa's current debt situation and how we have found ourselves here. Now, I know AFRODAD does a lot of work in this area, so my question to you is, what changes do we need to see take place at the global level to help Africa, number one, navigate out of this precarious situation, and number two, ensure that we don't fall back here? So, Jason, over to you.
Thank you, Tanai, and thank you to Nora and Aurore for those wonderful presentations. I think the short answer is just an entire overhaul of the global architecture, right? Because I think when you look at how the system has been operating since the Second World War, you realize that it had not been designed for a place for the continent, for the African continent, as being a very proactive and serious player in this entire machinery. And I think the examples that highlight this in part in the two presentations is when you look at the impact of COVID-19 on the continent, but also the impact of COVID-19 on global supply chains and value chains. Africa is a net exporter of raw materials into the global industrial process. And when movement of those goods and services came to a grinding halt, many industries began to suffer, and consumers in the global north began to feel the pain. So I think the first point is, a significant overhaul of the system that then recognizes the role of the African continent in this way. The second point is to realize that debt financing is not a panacea for Africa's structural transformation. I think there's a serious problem with how debt financing has been thought of and been designed. It is looked at more sort of growth type projects, so big mega infrastructure projects. I liked some of the imageries in Nora's presentation, and you can also see, in Aurore's statistics, where the credit or the debt that's being accumulated by many African governments are going towards these big mega infrastructure projects that have a very long period of return and an excessively very long period of repayment as well, which means they're not generating revenues to address the financing gaps, the immediate financing gaps in this that our governments need. So I think there's a problem there with how debt financing is then configured or thought of in that sense. The third point is the model of transformation, if you like. There's a big emphasis on growth as opposed to an emphasis on development. Now, allow me to qualify this a little bit. I think growth is a very narrow pathway for countries or for economies to transition across to being very rudimentary to then being advanced. Whereas development tends to be a bit more broader, takes into account beyond economic, but also integrates in some of the social aspects that are required to sustain populations and citizens, and as Nora mentioned, put human rights at the center of what is being done. I think we've got actually a very serious problem with that type of model that has been promoted by the kind of technical advice that has been given to our governments. So I think for me, the ongoing discussion around reforms, around what we need to do, is really think through some of these very fundamental aspects on the international architecture, the role of the African continent in this architecture, but then also the approaches to what we need to do when we look at different forms of finance. I think just one point I'd like to buttress on the role of credit rating agencies also is that the negative effect that they've actually had on policy choices or policy options that many African governments had to make for fear of downgrades. They therefore decided not to opt in to some of the debt relief programs, like the GSSI, like the G20's Common Framework, and therefore, that risk of being downgraded has actually undermined efforts of trying to implement what are also piecemeal recovery programs or relief programs, but nonetheless something that could have worked. So I think that would be my initial sort of submission.
Yeah.
Thanks.
Yeah. Thanks for that, Jason. I think really sort of double clicking on, some of the points that Nora made in her presentation in terms of, and I like, you're right, the overhaul of the international architecture because of the implications it has on the African continent. And so now we're going to move on to our next panelist. We are also privileged to have here Dr. Theophilus Acheampong. He is an economist and political risk analyst with over 10 years experience working with governments, private investors, and international organizations on natural resource governance and public financial management issues. He's also worked as an independent consultant on various projects in the global energy industry, particularly in upstream oil and gas, and in providing economic analysis and market research focused on frontier emerging markets. Theophilus, my question to you is similar to Jason's. Given your area of expertise and now trying to localize some of our forward thinking and solutions, what do you think as a continent, African countries need to do to navigate out of the situation, as well as also ensure that we don't find ourselves back here again? Over to you.
Yeah, thank you very much, Nora, and pleasure to be here. And I must commend Nora and Aurore for that very brilliant presentation as well. I think what the two presentations do, together with Jason's remarks as well, is really set a bit of the context. And for me, there are maybe two periods that we sort of need to look at and analyze a bit more carefully here. The immediate from 2000 to about 2007, where a lot of African countries got the MDRI, the Multilateral Debt Relief Initiatives, and we had HIPIC, and there was a reduction in public debt as a result. But subsequently, and this you can see in the Nora's data, from about 2007, 2008, the markets are suddenly opened and African countries have a range of other financing choices, and they start then going to the market by issuing Eurobonds and other commercial paper in that regard as a means of sustaining and financing their budget. But many of the countries actually got caught up in what I call this debt binging, where many of the loans that they took ostensibly for infrastructure financing, some of them even became white elephant projects. And as we speak currently, a number of the countries who are selling commercial paper, Eurobonds, etc., aren't necessarily using those proceeds to actually finance new infrastructure per se, but actually repaying, some of those existing debts. And I can highlight Ghana, I can highlight Zambia, and a few other countries where this is particularly being quite a big problem. And what has also changed, I suppose, in the last 10 years is also the role of other, what I call bilateral donors in this equation, particularly China. And a lot of the debt or concessions that they have offered various African countries to be able to finance their budget. So you see two big players in the equation: more private sector debt, more sort of Chinese bilateral debt on that side, and less so of the let me call it multilateral players, your typical IMF or World Bank or African Development Bank and things like that. And the question that often has come in a lot of the debate really is that when you take the role of these agencies vis-a-vis even the credit ratings assessment, it seems as though there seems to be some quote unquote African bias in that regard. I am currently actually involved in some research now where we're actually trying to test this thing out empirically, purely because the ratings issue is not just a question of economic growth. There are a lot of numbers and a lot of metrics that actually goes into country risk assessment. And I sit on a desk where I'm involved in some of these conversations and also engage with investors in that. So you can actually talk about three broad variables. The first one is the economic variables, definitely GDP growth, but within that, you've also got, for example, a country's tax potential. We're looking at your international reserves. We're looking at your dependency on things like commodities. Have you participated, for example, in an IMF program over the last 3 to 5 years? All of these things go into, let's call it the economic box. And then secondly, you also have what I call the political drivers or the political economy variables, where we're looking really at a country level, the political stability, the rights issue, and the third component becomes the external factor. So if the US Fed decides to actually hike up rates now, you tend to see a ripple through impact of that on some of those quantitative easing and the tapering effect filter through at the country level. So what I'm really trying to paint here is that it's actually quite a complex mixture or box of variables that goes into the assessment. And what we're doing now really is, if we take a subset of African countries versus other countries, for example, in Latin America that have all accessed the Eurobond markets, and we pick things like the yields and the sovereign spreads, if you control for all these variables, then we would be able to pretty much say whether or not there's this kind of quote unquote perceived African bias in terms of how the ratings agencies work. But from where I sit, I have seen both sides of the argument, where sometimes someone is sitting at a desk, say in London, collates all of the information, does the analysis, and then puts an assessment out. And other times the countries just don't provide enough data or a data point, or when a query is actually sent to a country, sort of say the Ministry of Finance, to provide further details, that is just not forthcoming in that regard. I think going forward, a number of things can be done. There are talks about some African kind of ratings agency in that regard. It will be interesting to see how that materializes. But I think fundamentally, it really comes down to the political economic choices of variables that countries on the continent have. In a post-COVID world, in a post sort of Russia-Ukraine world, financing, and particularly debt financing, would be a key component of the various budgets that countries pass going forward, just because they're not raising enough domestic revenues locally. So in the interim, the gap has to be filled from somewhere. And that's where I think the quality of those loans that they're procuring, and importantly, the projects that those loans are financing, becomes really, really critical, because I have been privy to unpacking some of these things in some countries, and you realize that you come to me and say you need $1 billion to finance your budget or to build a road or a hospital. But subsequently, some of those monies are diverted to fund other things. And then it raises a red flag in terms of your potential non-payment risk issues. And that red flag then means that I have to calibrate my models to reflect, right, that increased premium in terms of that non-payment issue. So as much as, yes, we kind of highlight the role of these global ratings agencies and international capital, etc., equally, African countries, I think, need to do a bit more in terms of the quality of spend that they use these monies for, especially given the challenges with weak domestic revenue mobilization. Thank you.
Thanks, Theo. Theo, I actually want to, as sort of we open it up now to have this conversation, as I mentioned earlier, please, if you've got any questions, please put those in the chat. But Theo, you mentioned it in passing, but I kind of want to probe it a little bit more. The current discussion about a potential, African credit rating agency. I mean, you've already highlighted how you think African countries need to improve the way that they're working, right? Do you think that there would be value in having an African CRA in addressing some of the issues that currently, for example, Nora spoke to?
I think yes, and what that would actually do is it's another channel or conduit to access information. So as Nora and Aurore kind of talked about, there are three kind of big players in this space at a global level: Fitch, Moody's, and S&P, and they would do these ratings assessments sometimes on an annual basis, sometimes on a quarterly basis, depending on how the fundamentals sort of change in that regard. I think having a sort of an African response to that, at least at the multilateral level, would help, because what that does is it offers another channel or conduit for financiers to access other information that perhaps the main three are not considering in their assessment. Because often the criticism has been that, yeah, how come, for example, Argentina, which is like a serial defaulter, and has actually gone to the IMF as much as many of the African countries, seems to be getting a relatively preferential deal on the international capital markets than, say, Ghana, where I come from, or South Africa, or some other country in that regard. And what an African ratings agency could do really is some sort of signaling to the market. I'm not too sure what the uptake of that would be from an investor point of view, but there's nothing that says in the African proverb that you can't have too many people offering that information.
Yeah, thanks, Theo. I think thanks for those thoughts. Really helpful. Jason, I want to come to you now. As I mentioned earlier, I know AFRODAD is doing a lot of work targeting sort of, as opposed to what Theo has said, but really sort of the global conversation. And I know that you recently did a piece of work where you were talking about how Africa now needs to take a much more proactive stance to these conversations and potentially start serving as a rule maker vis-a-vis a rule taker. Could you unpack a little bit about that work that you've been doing and how it sort of speaks to Africa's current situation?
Yeah, thanks. I mean, I think at the outset, it really connects with what Theo is saying about the possibility of countering global North agencies in terms of how they determine the flow of resources into the continent, right? And I think the idea, for example, of a Pan-African credit rating agencies is a potential double-edged sword. On the one hand, yes, it does offer this counter narrative in terms of the variables that would be considered in terms of attracting investor financing into the continent. But on the other hand, it then also reinforces this idea of private markets or private sector financing as being the main engine, or debt financing as being the main engine for transformation onto the continent. And while this might be true in the immediate term, I think certainly in the medium to the long term, this may not necessarily hold. And I think that's the double-edged sword there that we have with a potential CRA. The idea of Africa a rule maker and not a rule taker is that in trying to reform the global architecture, the idea of an agency needs to be at the center of everything that we do. I think this idea of us going cap in hand constantly to the global North seeking finance, or to even the East seeking finance for our own transformation, is something that needs to cease and come to an end. And one of the ideas is to embody and actually strengthen some of the ideas that are sitting in the African Union Commission. For example, the establishment of an African financial architecture that is very well articulated with regards to an African investment bank, an African central bank, an African monetary fund, and all of that. So I do think that is really at the center and core of Africa a rule maker and not a rule taker. And lastly, I just wanted to add that I think we have to be also very cautious in this idea about where we center debt financing for transformation. I feel it's very important that we do not see this as a solution. Yes, in immediate crisis times, it is possible, but I really think we need to bring the conversation back to how do we stem the huge amounts of financial resources that are leaving the continent in the form of illicit financial flows, for instance, debt servicing, vis-a-vis what could then be generated on the continent. And I think that is really also an equally important part of this conversation within the two presentations that both Aurore and Nora gave us. Thanks.
Okay. Thanks, Jason. And I think that's such a good point to be emphasizing, right? How can we maximize the resources that already exist within the continent and be much more inward looking rather than external in terms of financing our own development. So we have about 5 minutes now before we conclude this session. And so what I'm going to do is just do one quick round to hear some final thoughts from both the panelists as well as the presenters with regards to this conversation. And so, Nora, I'm going to start with you. When you concluded your presentation, you had 4 recommendations that you had for us. I'm keen to hear from your perspective, which of these do you think we need to start in terms of prioritization, leaning into first for us to start heading in the right direction?
Yeah, thanks for that question. And for me, it would definitely be the stricter regulation of credit rating agencies. This aspect that governments are maybe acting in a way that they avoid downgrades at any cost, and that finance ministers are almost reporting to the credit rating agencies rather than to their people. I think this for sure has a big impact on the interest. I also think the aspect that Jason brought in, however, is very interesting, that it shouldn't be the international financial markets that are the solution. However, in the meantime, that as they are, it's important that there is regulation of what is the actual role of the credit rating agencies, and that it doesn't go beyond providing information. And then, yeah, I could almost bring in all the recommendations, but I think the part that they don't implement policy is most important for me.
You're right, because I think it's sort of shifting the accountability of governments from the public, its people, to sort of these international actors. I think that makes a lot of sense. Theo, if I was to come with you for some final thoughts in about 60 seconds, what would you say?
There's a lot to say on that. But I think an interesting point, really, I think we kind of need to highlight here is that, and I agree with Jason's point that financing doesn't fill the void. You need to raise your own resources to do that. But the question perhaps we haven't asked is, why is that much more attractive for our politicians and policymakers than doing the hard work of actually, domestic revenue mobilization or taxation? The answer is very simple. If I go to the capital markets and someone says that you're going to offer you, 10%, 12% sometimes, on that, of course, they would take that. And there's very little, the accountability shifts from the domestic people or the citizens rather now to the agencies and whoever is participating in the debt market, back to Nora's point. But I don't think the solution necessarily is better regulation of them, because if you're raising capital in London and these agencies are, regulated, let's say by the Financial Conduct Authority or whoever, I struggle to see how an African government sitting somewhere in Africa would be able to have jurisdictional control over them. What I think we need to do, for me, really, is to get back to the drawing board. We need to raise the money and finance our resources internally ourselves, because at the end of the day, whoever pays the piper controls the tune. And that's what I would say. Thank you.
Absolutely. I completely agree with that. And I don't think I can see Jason nodding fervently already. So maybe Jason, what are your thoughts on this?
No, I think it's for me, it's let's just try and figure out ways of raising revenue, domestic revenues. We have raw materials, we have the know-how of how to utilize these resources, and I think looking inwardly within the framework of what the African Union has on its agenda with regards to a financial architecture, the continental free trade area, for example, as well. I think making those realities functional will actually be a lot more valuable and sort of erode this desperate need for debt financing. Thanks.
Great, thanks, Jason. So I think what I'm hearing from this conversation is we need to also start looking, in order to address this debt situation internally, to ourselves, promoting domestic resource mobilization. And I think, Theo, to your point, right, whoever plays the piper, thingy is the tune, I've forgotten the thing, but basically that the accountability really needs to lie with the public rather than these agencies. So thank you so much to Aurore and Nora for your presentations, as well as Theo and Jason for being panelists. Thank you so much to APRI for putting this together. Thank you as well to the audience for listening in to the conversation and taking the time to be a part of the webinar. We are really hopeful that this conversation contributed to the broader conversations. And also, please, can we encourage you to take a look at these policy briefs that have been put together by Nora and Aurore. So we'd like to wish you all a wonderful rest of your day. Again, good evening, good morning, good afternoon, depending on where you are. And we look forward to seeing you at the next webinar. Thank you again. Bye, everyone.